Hi, I'm Jimmy. In this video, we're looking at different economic indicators to try to answer the question, should we invest now or wait for the stock market to continue falling? Are we better off investing now or waiting? Now, clearly, when we look at the stock market over the past few years, well, the overall trend is higher, but we can see that we've had a decent drop lower in the past few months. Really, since the start of the year, the S&P 500 and the NASDAQ are down a decent amount. And if you've been invested in the market at all, I'm sure you've seen a lot of that reflected in your own investment portfolio. Now, before we jump into it, I actually want to tell you about a website that we're building that will help us quickly and easily calculate the fair value of different stocks. And basically, the way the website will work is we punch in the ticker of the stock we're interested in up here. The computer will then do the calculation using analyst estimates for free cash flow, which will automatically be pulled down for you. That will then calculate our own fair value based on whatever required rate of return we decide to use. The idea behind this website is that it will be quick and easy to calculate the fair value of a whole bunch of stocks. So if we're a value investor, this could be a great place to start. Now, if you'd like to sign up, I'll leave a link in the description below. And the advantage of signing up now, we're expected to have this website launched by the end of next month, by the end of June. And the advantage of joining right now is that we're locking in the price. If you sign up before the website launches, the price will be locked in forever. That being said, let's jump in and look at some of the economic indicators now. Now, clearly, the first and probably most important economic indicator for us to consider right now is inflation. We can see when we look at the past 20 years, well, inflation is sitting above 8% right now. Over the past 20 years, it hasn't been anywhere close to that. In fact, we haven't seen inflation this high since the 1980s. So clearly, this is going to be a point for the bears because this is a bad sign for the economy. Now, the flip side to inflation, which is ultimately higher prices. By the way, I know that there's a lot of ways to measure inflation. The Consumer Price Index is the one that the Federal Reserve uses, so this is probably a logical place for us to start. That being said, an offset to higher prices would in fact be higher wages. And when we see the wage growth put out, a wage growth indicator, which is put out by the Atlanta Federal Reserve, well, we can see that we have seen an increase in wages recently. But we might notice that wages are sitting at an increase of about 5%. Meanwhile, inflation is going up more than 8%. So at the end of the day, between inflation and wages, when you combine these two, well, together, these two have to be a point for the bears. So I'll give this little point to the bears here. Right now, the bears are winning 1-0. Okay, now let's look at consumer confidence. Now, consumer confidence is very important. And basically, this is a measure of how confident people are in their own economic situation. And we can see that recently, over the past year or two, since COVID began, since 2020, well, consumer confidence has dropped a decent amount. In fact, it hasn't been this low since the financial crisis of 2007 and 2008. So again, when we're coming up with a score here, we got to give this point to the bears since this is a negative sign for the broader economy. Now, if we want to look for a silver lining, one economic indicator that is important is jobs. And we can see that the U3 unemployment rate, which is not a great measure of unemployment, but it is the most popular measure of unemployment. And we can see that overall, the unemployment rate is in fact trending lower. Well, we can couple that with initial jobless claims. And while we are seeing some increase in the past couple months, broadly speaking, from a bigger picture perspective over the past year or so, this is trending lower. So I think that the combination of these two would imply that this is a point for the bulls. Okay, now let's go take a peek at housing. So this economic indicator measures the number of new houses being built. And we can see since the financial crisis, outside of the little chaos that happened in 2020 when COVID all happened, well, outside of that time period, well, broadly speaking, the trend has been higher. Now, I would say that this should be a point for the bulls because the trend has in fact been higher. But during most of that time period, at least for a lot of it, well, interest rates were very low or even falling in some cases. Now, there was a period in the middle here where interest rates did tick up a little bit. And right now we're seeing interest rates move higher again. Now, this is something that the Federal Reserve is somewhat forced into to try to combat inflation, which we already saw. So it would be, I think, a bit naive for us to say that we don't think that higher interest rates are going to hurt housing starts. So, although this is a positive sign right now, and looking just at this chart, I would say that this chart looks like it should be for the bulls. I think we're much safer and we're much more realistic to give this point, to make this a neutral point, since housing starts are in fact trending higher, which is positive, but they're running into some economic headwinds. So that's somewhat of a negative sign. So there, I'm going to give this point to both a point for both the bulls and the bears. Okay, now let's shift over to manufacturing. So this is the ISM economic indicator, ISM manufacturing indicator. And basically, the key level here is 50. So the way this indicator works is anything above 50 is positive, it implies positive growth for the industry. Anything below 50 implies negative growth for the industry. So yes, we have seen a tick lower recently, but overall, the economic indicator is still above 50, implying some positive growth. I'm not overly concerned about the negative tick at this point, since we can see that even in the past 10 or so years, we've had a few turns lower where the economy continued to move higher. For example, 2015, 2016, where the economy did fairly well during those time periods, but we did see a rollover in the ISM manufacturing indicator. Now, that being said, we do not want this one to go negative in combination with lower consumer confidence, higher inflation. These can be somewhat dangerous things if manufacturing were to slow down, because that would likely hurt things like the unemployment rate more than the economy needs for it to right now. So I would say overall, this is still a positive sign for the bulls. So we're going to give the bulls this point. Next one is household debt. Now, this one can be a little bit tricky. We've actually got two economic indicators that track household debt. So this is a big picture. We can see that this chart goes back all the way to the 1960s. Big jump up leading to the financial crisis. And since then, it has trended lower, except for the little pop right here when the Federal Reserve was printing a whole bunch of money. COVID happened, people were stuck at home, and looks like they needed to take out more housing debt. But overall, I would say that this trend is in fact heading lower. But then another economic indicator to sort of double check ourselves we can look at is they track how many people are 90 days late on their credit card bills. This is the percentage of people late on their credit card bills. And we can see that, yes, we did see an uptick in the most recent month, but broadly speaking, once again, coming out of COVID, coming out of 2020, that number seems to be heading lower. So it looks like at least some percentage of people are starting to catch up a little bit on their previously late credit cards. So again, I'd have to say that this is a positive sign for the broader economy. Okay, now this economic indicator, the next one, is an important one, and this is the Treasury yield curve. Now, you might have heard that about the Treasury yield curve, and basically what we don't want is we don't want the yield curve to invert. We don't want short-term rates to be higher than long-term rates. In theory, if you're going to invest for 30 years, you should get a higher interest rate than if you're going to invest for 2 years or 6 months or 3 months. It should be sloped like that. Now, we can see that right now, it is in fact a positive yield curve, which I would say is a positive sign. But I do think it's important to recognize that this is not necessarily this is not necessarily an economic indicator that has to stay negative. So if we roll back to not too long ago, in fact, in April of 2022, so we can see that in April of 2022, this is what the US Treasury yield curve looked like. And here, an important measurement is the 2-year compared to the 10-year, or even the 2-year compared to the 30-year, although the 2-year, 10 years tends to be a more popular one. Either way, this is inverted. You would get paid a higher interest rate for investing in just 2 years versus investing for 10 or 30 years, which implies a negative sign for the economy. Now, broadly speaking, there's no hard and fast rule in this, but broadly speaking, they say that when the yield curve inverts, it tends to be 12 to 18 months, I believe it is, for the economy to go into a recession. And ultimately, that's what we're looking at here. So when we switch back to our scorecard here, well, clearly this point belongs to the bears since it has just recently inverted. The yield curve has just recently inverted, which implies a recession is coming in the not too distant future. Now, I don't want to give the impression that these are all equally weighted. These are all the same. I actually think that the weighting would be a bit more like this, where we would see both inflation and consumer confidence getting much more weight than many of the other economic indicators. So, to answer the question, do we invest now or wait? Well, I actually think, personally, I think that this is the ideal time for value investors. I think that for a long time, much of the stock market has been overvalued, and good opportunities, good value opportunities appear to be popping up all over the place. In fact, I think that for those people that can strategically put money to work in places, in stocks, that in companies that look undervalued, and they're planning on being long-term investors, because obviously there's a ton of short-term volatility. If we are willing to sit there and wait and buy the opportunities now, I think that this will make our portfolio, it could make or break our portfolio over the next couple of years. The worst thing many investors do is they'll get fearful when this is happening because the market is fearful, and they'll pull their money out and sit out of the stock market. And then they wait for everybody to get all excited again and the stock market to start running higher. And that's when they jump back in. There's a reason that Buffett says to be fearful when others are greedy and greedy when others are fearful. This is that fearful time that I believe that the best move we can make right now is to do our research, look for good investment opportunities, good value investment opportunities, buy them and hold them for the long run and let that play out. That being said, if you'd like to sign up for our coming website, which again will be up in the running by the end of June, which will give you access to our discounted cash flow calculator and a few other features that we're adding in the not too distant future, that way we can help know where stocks could be valued. If you'd like to sign up for that, I will leave a link right here, link in the description below. Thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.